every month inflation stays this high, middle and lower income Americans suffer. And they've already been suffering since 2021. And the longer you drag this out, there'll be a political solution.
Hello, everyone, and welcome to another episode of The Pragmatic Investor. My guest today is Kashyap Sriram, who already came on the show a few weeks ago after he posted a viral thread on Twitter where he expressed all the concerns he had on NVIDIA. So, today we had a chance to revise this short theory on NVIDIA and also to talk about the general market outlook. In today's conversation, Kashyap told us about his general outlook for the economy, why he is also shorting supermicro computers, what he thinks about the outlook for inflation, rates, the effects of war and how investors should prepare for it, and of course, Bitcoin, gold, and Austrian economics. I really enjoyed this conversation today with Kashyap. I felt like we really covered a lot of ground and I really got some very good insights into how he thinks about the market. So if you haven't already, go ahead and follow him on Twitter. And if you haven't already, go ahead and subscribe and like The Pragmatic Investor, whether you're watching this on YouTube, Spotify, or any other platform. As always, I hope you enjoyed this conversation as much as I did.
All right, welcome back to the show, Kashyap Sriram. Thanks for coming.
Thanks, James. Good to be here.
Awesome. Well, a few weeks ago, we had the pleasure of talking, and we talked a lot about NVIDIA and, of course, everything that was going on in CoreWeave. You had that brilliant thread on Twitter addressing a lot of the issues. What is the update on NVIDIA? I mean, since we had that conversation, we did see NVIDIA go down quite a lot. It's sort of climbed back up, I guess, kind of flat, you could say, in a way. What's your outlook on there? Any updates on NVIDIA?
And the CEO is still selling stock, so that's happening. And as for the rest, I guess we'll just have to wait for the 13F filings to come out, so we'll know who has sold, who hasn't. So I'm guessing the big players are pretty much out by now, but we'll see. But NVIDIA reminds me of this quote that I read about how a company goes bankrupt. It's like it happens gradually and then all of a sudden. It's not like you're getting a smooth curve down or a smooth curve up or something. It's like the event just happens and then you have the consequence. So I think with NVIDIA, we'll see something similar.
Right. Well, in any case, it's not just NVIDIA. You continue your relentless attack against the chip manufacturers. You recently had another thread on super microcomputers, which I thought was very interesting. And you propose shorting the stock. You say, I am short the stock. Tell us a little bit about your thoughts behind this play.
Yeah, so Applied Digital, these are all companies that I started following mainly because I started following Applied Digital back when it was Applied Blockchain. And I kind of saw that whole evolution. And NVIDIA, you know how it fits together in this with the whole CoreWeave deal and all its history, right? So I was looking at Supermicro and it just struck me that stock is just straight up. Like stocks don't move like that. And I couldn't find anything exactly wrong with the company. It's not like I believe they are inflating their receivables or something. Although they have had issues with the SEC wherein they have had to pay a fine and admit to have inflated revenues in the past. But I mean, that's the past, right? We should just put that in the past and look at what's happening with the company right now. And what's happening with the company right now is I don't see any red flags the way I saw for NVIDIA, but it's just amazing the way the stock has moved. You don't get a stock going from $25, $50 all the way to $350 in such a short period of time. And I read the bullish report, and the bullish report is basically just saying AI, or the fact that the company's stock is up like 150, 200% means it's going to go up another 100 to 150, 200%. And like, that makes no sense. So I just looked into the 10K, which they filed for the June quarter. And I saw that it's just grossly overvalued. I mean, here you have a company which is pretty much a manufacturing business being valued at this amazing multiple. And if you just look at their margins, you will see that there is no way they should be valued at this level. I mean, you have like you take a stock like Meta. Let's say Meta trades at 100 PE. Okay, but Meta has 80% gross margins. Meta is growing revenue at say 30% a year. So that 100 PE, by the time the business stabilizes, is going to get compressed to a 20 PE. And if the S&P is trading at a say 25 PE and a growth stock is trading at a 25 PE or a 30 PE, that's still acceptable, right? But here you have a manufacturing business trading as though it's Meta or an Apple, which doesn't make any sense to me. So that was my reasoning for getting into it. So it's more a valuation short, and it's also a play on the inventory cycle because you saw what happened with HPQ. You saw pretty much what happened to all the other hardware manufacturers. So outside the semiconductors, which is a bubble, what's happening is that the companies, the hardware companies are actually getting penalized when they report lower revenues and they report inventory write-downs. And I believe, semiconductors are not going to be immune to this. So at some point, pretty much the whole space, when they take inventory write-downs, it's like looking at retail, right? When retail is suffering, the entire sector is suffering. You're not going to have a Walmart or a Target just shooting up because, people like the stock because they say the right things or something. Like, that's not going to happen. So when the correction happens across the space, it's going to hit the whole space. So SMCI is just a valuation short. It's not a allegation of, something shady going on behind the scenes. Although, if you look at some of their practices.
Sorry, you did mention some of the some of their suppliers is the CEO's brother. It's a bit of a family thing going on over there.
It is, yeah. But again, it's a pretty common thing in Asia. Like even if you look at South Korean stocks, you'll find a lot of dealings like that. And even in Japan, it used to be pretty common until I think at some point the government came in and said you can't do this anymore. So Japanese companies, the big say 10, 20 companies, they would hold stock in the other big 10, 20 companies. It used to be like a clip where, you hold the stock of the other company. So, these webs, and I'm from India, and in Indian stocks, like 50% of the entire stock market is owned by the groups that control the companies. So it's like a pretty big number, but so that's in essence, that's not a reason to say that there's something shady going on.
Right.
It's a cause of concern because minority shareholders can get hurt, but that's the same almost with other companies as well, right? There are always things that management can do to hurt minority shareholders. And it's true even in US companies. You look at oil and gas, Carl Icahn has done plenty of things to hurt the shareholders of companies that he has invested in. So just Google Chesapeake Energy and you'll have you have all those dealings going back. And recently with Sandridge, what he did. So, the family dealings, the controlling interest is not exactly a problem. It's just something that I found very interesting.
Right, of course. Something that investors have to take into account. I was actually reading, someone was commenting on, I think it was Korean stocks, and saying, "Oh, why are these Korean stocks or Japanese stocks so cheap?" And actually, one of the reasons is precisely because of what you're saying. I think that they have a very kind of a lot of these stocks, even the ones that are trading publicly, are, kind of owned by big families, and they still have that mentality. Well, this is our family company. Really, it's not kind of. So yeah, they the shareholders kind of come second, and also they have stuff like very big cash balances, for example. They're very unaggressive. So I think that kind of explains. But in terms of the microchips, then would it be fair to say that you see an overarching kind of basically, like you say, that we're entering the part of the cycle where basically all the microchips are going to perform poorly now because of where we are in that cycle?
Yeah, absolutely. If you look at, so with any kind of manufacturing business, it's always an up down cycle, right? Pretty much any commodity, and chips right now are pretty much a commodity. So with anything, you see these cycles. You see these cycles in the bigger markets as well, but putting that aside, so 2020, 21, you had these huge supply disruptions because of COVID, because of the lockdowns. And it got to a point where even the basic logic chips that, say, a Tesla would need to, do the up, down on the windows, like even that wasn't available. And so you had this period where everyone was ordering inventory. So this is something, it's a typical supply chain concept called the bullwhip effect, wherein, I mean, you are a retailer and you're facing increased, footfalls in your store. What do? You order more inventory. And the guy who's selling to you, he sees that you are ordering more inventory. So what does he do? He orders more inventory. And this just pretty much goes back all the way. And then the manufacturer is like, wait a minute, I need to increase my production because there's this huge demand. And 2020, 21, every day in the news, you were bombarded with the fact that there just isn't enough chips and there just wasn't enough of anything in goods, right? So what happened was a typical over-ordering cycle. Manufacturers ramped up capacity, ramped up production, and then everyone, took on this huge inventory and they got kind of stuck with it. And eventually end demand collapsed because the Fed raised rates. The economy just wasn't able to sustain those high rates. I mean, contrary to what you see, seven stocks is not the economy, right? Like the real economy is actually suffering. Every single data print you look at it, it's suffering. And the whole thing just fell off a cliff, like retail demand slumped, demand for automobiles slumped, demand for PC slumped. I think something like 40% decline in demand for PCs or something. Like, don't quote me on that, but demand for smartphones slumped. And all the, when COVID lockdowns happened, the companies instituted work from home, which means they had to upgrade the IT infrastructure. They had to give laptops for employees who, were used to working from workstations. And you had this whole demand for IT and computing equipment. And that is not going to repeat. That was a pretty much one-off thing. But it looks like manufacturers started to believe that this would repeat. And now you have the bust part of the cycle where you're grappling with excess inventory. And the other problem in this situation is you had this US sanctions on Huawei. That's the 5G giant in China. So because of the sanctions, the Chinese did a lot of overordering because they were not sure whether they would get the supplies that they needed, right? And so again, there was a lot of stocking up over there, and that's ending now. So we are dealing with all these repercussions at the same time. And the final dynamic here is when T-bills pay you over 5%, how much does it cost you to finance your inventory, meaning your working capital? If you can get other than CoreWeave, which magically somehow gets loans, using chips as collateral, a regular reseller, regular holder of inventory is not going to, like you cannot go to a bank and say, you can put your money in T-bills or you can give me money to finance all this inventory at 5%. Bank would be like, give me 10%. So what happens is when the cost of holding your inventory goes up, you tend to reduce your inventory level. So you have that dynamic in place as well. So all these put together, I think chip industry is very much in a downturn, and the statistics say it, like the Semiconductor Industry Association statistics say it, the IDC statistics on PC sales and everything, like that says it's going down, but the stock market isn't saying it yet. So I think that's where the asymmetry lies. And again, I'm not a semiconductor expert. I'm not a chip expert. I'm just looking at what's happening and just forming the thesis based on the macro and what I have seen. So, yeah.
Right. The only issue, of course, is the old saying, right? Sometimes the market can stay rational longer than you can stay solvent, right?
Right. Yeah.
Along those lines. So obviously, a lot has been said in the recent days also of the conflict in the Middle East. Now, I don't want to get too political, but I'd love to hear your thoughts, and also more from an investing perspective. What do you think this outbreak means to investors in terms of risks and, possibly also in terms of opportunities?
Well, I don't want to get too political either because, the moment you say something is going to get twisted 10x, it's going to be like a Chinese whisper, and then they're going to be like, oh, this guy is, fill in the blanks. So let's not get into that. But one immediate thing that concerned me is the fact that Israel also attacked parts of Lebanon. And that just got me thinking. In 2020, there was a explosion in a warehouse in Lebanon where a huge amount of ammonium nitrate just ignited. And
Right. Yeah.
if you look at, that's the feedstock for fertilizers. So fertilizer stocks are going up on this news. And I think that's something that investors can look into, especially considering how cheap those stocks are. So one of my problems with performing in 2022 was actually this, like I'm a fundamental focused investor. And let's say I buy a fertilizer stock at an 8 PE. The company grows earnings, the company grows revenues, but the stock goes down and it becomes a 4 PE stock. You buy a 4 PE stock, there's nothing wrong with the company, it becomes a 2 PE stock. So you had the situation wherein valuations, fundamentals just didn't matter. So now if you look at what's happening with especially with the fertilizer stocks, what you can see is that finally fundamentals are starting to matter. And these stocks are going up. So I believe that's a trend that we will see continue. And other investment idea is you look at what Israel is known for. It's known for pharmaceuticals, generic pharmaceuticals, not the branded drugs. And it's known for its tech industry.
Right.
So Silicon Valley, they invest only in mostly 3 places outside of US, right? One is Israel, the other is China, the third is India. And so this is, Israel is a pretty big market for venture capital. So you have to kind of ask what's going on there. And you have all these Israeli tech companies listed on the NASDAQ. So you kind of have to like look at what's going to happen to the valuations of those stocks, because it's not that the stocks are overvalued or undervalued. Like that's not the criteria here. It's like you have this big institutional investor and they're like, what is my exposure to Israel? And if they see that, they have this stock which has exposure, they just sell it, get rid of it. They're not going to do the due diligence to figure out whether, so for instance, my website runs on Wix.com. It's an Israeli company. And they have said they have data centers all over the world. So your data is safe and all that. But you hold the stock, what are you doing? You're just thinking, okay, do I want to take the risk of being in an Israeli tech company when Israel is at war? And we actually saw something similar happen when India almost went to war with Pakistan, wherein the tech company CEOs actually scrambled and they contacted New Delhi and said, please do not declare war because our customers, everyone is scared. Like you're seeing, I've seen those dynamics play out in a different part of the tech world in the past. So that gives me my perspective. So I wouldn't want to be investor in Israeli tech companies now, regardless of valuation. Whatever the fundamentals, whatever it is, you don't want to touch that. And then you look at, okay, what else does Israel have? It has a massive gas field, and they just told Chevron to shut production because they are scared of, causing some kind of issues that, one false step and you never know what could happen, right?
Right.
So who is the beneficiary here? And sure, US has its LNG infrastructure. US is like the number 2 oil producer or number 1 oil producer in the world. So, you can look at the US as a beneficiary, but US is right now a beneficiary of almost everything, right? You have conflict in the Middle East, US benefits because defense stocks goes up. You have the Russia-Ukraine war, US benefits because Europe is buying LNG from the US. So, that's pretty much played out. Like everyone knows that US is going to benefit and the stocks are priced accordingly. So I just thought, okay, what's not priced accordingly? And then I looked at the Aussie dollar. It's just straight down, right? And that doesn't make sense because, sure, Australia has its own problems. So there's probably a good reason, but with currencies, it's all relative, right? And Australia has LNG, Australia has coal. Australia is about as far removed from this conflict as you can get. So why not long Aussie dollar? So I'm just thinking about trades which are not, you could just do the first order trade and say there's conflict, buy the VIX, buy gold, buy oil, buy treasuries. But looking beyond that, I was just trying to put together some trade ideas.
Yeah, absolutely. So the idea is, of course, that the Aussie dollar will do well on the back, perhaps, of those higher commodity prices, brought about, well, first of all, by the war. Secondly, of course, we did have that inflation release, what was that, yesterday, coming in a little bit hotter. So, kind of people reigniting that debate on inflation and deflation. Where do you stand on this debate moving forward? Because, I know you do have that kind of background on Austrian economics and, they do a lot of things right, but they have been wrong before. I know that a lot of the Austrian economists have been talking about inflation for years, and just buy gold. And obviously, I'm not against buying gold, but as a trade, it hasn't done great. And inflation, obviously, in the previous decades, has been almost non-existent. But now we're starting to get some good arguments, I believe, for sustained inflation over the next decade, maybe longer. So what are your thoughts on inflation right now and that outlook for inflation?
Sure. So I was reading the Austrian economists who, when the Fed started QE in 2008, they predicted that this is going to lead to hyperinflation. There's a website, Shadow Stats, which does an alternative interpretation to the BLS CPI, and they were predicting hyperinflation 2012, hyperinflation 2013, hyperinflation 2014. And really, I mean, hats off to those guys, because those reports are still online. You can find it, you can read it, and you can see exactly what their argument was. And the reason the hyperinflation didn't happen back then is because 2008 was a massive deflationary shock, right? I mean, assets got written down, banks went bust, people lost their value, of course, homes got written down, the stock market took a dive, and the money printing that the Fed did was barely enough to get the economy out of the deflationary shock. And the other dynamic that happened was all this money that they printed went into tech. Right. And this is where you got services became super cheap because everything was subsidized by these tech companies making losses. I mean, you take grocery delivery. How did that come about? They lose $1 for every dollar in revenue they make, but it's subsidized by the VC money, which is again subsidized by the Fed holding interest rates at 0. So you had this whole dynamic where asset prices went up, companies, scaled in terms of revenues, and our lifestyle got cheaper on the back of someone else taking the loss. And those losses didn't matter because the market was very forgiving of losses, which is what happens when the cost of capital is 0. When the cost of capital is 0, you may as well just let valuations balloon. Your losses don't matter. You can get free money, right? And so on, living standard actually got better, even though the Fed was printing money. And then all this changed when they handed direct stimulus checks in 2020-21, and the money went from the banks to the VCs to these tech companies to the broader economy. It went directly from the Fed to the Treasury to the taxpayers, to the everyday Joe. And what did they do with it? Yeah, they spent it. Right. And they spent and spent and spent. And this was at the time when supply was getting destroyed because of lockdowns. So you had this huge inflation wave come up. And then the Fed had to act. When the Fed acted, the venture capital space pretty much died. I mean, you wouldn't see it in the tech stock valuation, but if you go talk to a VC, you would see that. I mean, Tiger Global had, I think, 50% down year last year or 60% down year. And I'm pretty sure they haven't even taken all the losses that they are supposed to take, right? So there's much more losses sitting in the space. And what happened is all these unprofitable tech companies, they had to raise prices. So you see all these like your Uber and your DoorDash and pretty much all these e-commerce companies, they are forced to raise prices. And at the same time, you have wages going up because of inflation. So now we have this whole spiral of all the things that led to higher living standards and pretty much 0 consumer price inflation. It's all reversing in the span of 1.5 years, which is a pretty big adjustment. I mean, you had 0 interest rates for close to a decade, and then all of a sudden interest rates are at 5.25%. And the economy does not adjust as fast as the Fed, can raise or lower rates. The economy takes its own time, and that's what we are seeing. So now what's happening is inflation is making a comeback because the sudden shock that the Fed induced, that's now worn off, and the underlying inflation dynamics still haven't changed. So for instance, last year, oil prices went down in the second half because Biden flooded the US with oil by opening the strategic petroleum reserve. But that's something that you can only do once. You cannot repeat that. So now that oil is gone, what happens? Oil goes back up again. And today I was reading about oranges concentrate being up like 50% this year, outperforming the NASDAQ. And that's a staple, right? So you have all these commodities going up, and olive oil has gone straight up because of bad weather in Spain. So you have all these other commodities that are actually in use that are picking up mainly because the supply hasn't gone up and the demand hasn't gone down. And the demand hasn't gone down because Americans have gone more and more into debt in order to fund their lifestyle. Because the thing with inflation is, it's easy to think like, I mean, if you have lived through the 70s, maybe, or if you have relatives who lived through the Great Depression or such events, you know that these trends can be long lasting and you try to kind of adjust your behavior accordingly. But if you have gone from having an extremely good year to a not so good year, you don't adjust your lifestyle immediately.
Mm-hmm.
So you're still going to travel, you're still going to do all the same things that you did. Maybe you cut out a little here and there, but broadly you're not going to change your lifestyle. It's going to take something pretty drastic to change your lifestyle, and that's not going to happen with 1.5 years of inflation. So probably what happens is you're going to have a prolonged period of high inflation before people change their lifestyle.
Mm-hmm.
So I think the kind of demand that we are seeing, it doesn't slow down as fast as the Fed expects, no matter how high they raise rates.
Right.
Because people are just going to load up on debt and maintain their lifestyle.
Mm-hmm. Right. Yeah, it's very interesting. You talk a lot about the commodities there, of course, all an important one. I actually wrote a report recently talking about that idea, like you said, that the oil reserves are down, and the idea that maybe, since we've been talking about war, that Russia could be looking at like weaponizing oil. They're sort of now trying to lift the price of oil, especially now that Biden is up for re-election, and obviously you could argue that they want him out of there. Some people want him out of there. It's very interesting you talk about that inflation. So basically you see that inflation persisting, but of course that kind of goes against the idea that we would have a big kind of recession or a big crash, right? So you can't really have both, right? I mean, if there was a big crash, that would stop the inflation, right? Or how do you see it?
Absolutely. So that's kind of what we saw in 2008, right? I mean, home prices just crashed, banks crashed, everything just came to a standstill, and then people readjust. So it's like you have a huge shock. People will definitely, like, I mean, if you lose a job, you're not going to consume the same way you did before. But absent a huge shock like that, inflation is going to remain a problem.
Mm-hmm.
So what the Fed, I mean, I think this is what they are trying to do. They tried creating that shock back last year when they raised rates so aggressively. But somewhere along the way, especially with the Silicon Valley Bank, I think they lost the plot. And they thought one bank rescue in the middle of high rates is not going to change much, but it changed everything. And if you look at inflation, that's right around the time when it started to make a comeback.
Mm-hmm.
So they had that, I think in like 10, 12 days, they reversed a whole year's worth of QT. So in March, the Fed balance sheet spiked up all the way back to the 2022 highs. And it all happened over a period of 2 weeks. Mm-hmm. And then they brought that down again. But I think that stimulus over that short period was enough to bring inflation back. And unless they really tighten and keep tightening and not repeat something like that. So actually, I mean, to go back, Silicon Valley was the perfect time to create that deflationary shock and inflation for good. Instead, they chose to print money.
Right.
So as long as the Fed, now people think the next time there's a deflationary shock, the Fed will just print money. And that goes into your inflation expectations, right? I mean, if the Fed had not printed money at that time, people would think, okay, so what if a bank fails? Money is still going to be tight. Now it's like, let's just wait for something bad to happen, and the Fed will go back to printing money, because that's what they've done for the last 14 years. That's what they continue to do, until something changes. So I think that's also playing into the inflation dynamic.
Yeah, that makes a lot of sense. And I think because there's at least a couple forces coming in here. A lot of people say, well, rates are so high, they've really tightened. Well, they haven't really, like you said, right? So they can value, they started printing. And then the other thing is the fiscal stimulus, right? I was recently looking at a chart that showed the debt in the US as a percentage of GDP, and never before has it been so high with unemployment so low. So it seems also like from the fiscal side, definitely, and that is going to, like you said, that is a much more direct channel towards inflation. And, they keep passing these bills, and the spending, at least from the fiscal side, doesn't seem to be stopping. So there could be that kind of fiscal-led inflation. The question is, how does that actually play out for stocks, though? I was recently talking to George Robertson, and he has this idea that, well, because we're going to see this inflation, right, this basically talks about nominal GDP. It says, well, nominal GDP is rising, and, ultimately, stocks report, companies report in nominal terms. The stock market, is basically, let's say, nominal. I mean, so, not to get, we're not Argentina, but let's just say the Argentinian market has done very well in Argentinian currency terms. What does that put? What's the outlook there for stocks in your opinion? Let's say at least US stocks.
Yeah. So the situation that he's talking about, you have the Fed expanding its balance sheet, you have the Treasury running massive deficits, and you have this underlying current of inflation. But at the same time, you have, nominal GDP growth requires some actual GDP growth plus inflation, right? So you should have a little bit of real growth in there. And now what's happening is the Fed is tightening, the Treasury is running massive deficits, real growth is slowing. And that is not good for stocks. And so let's say that part of your earnings growth is due to inflation because you're hiking prices, but part of it is real growth because you're investing in capacity, you're expanding operations, you're actually being more productive, right? Which is pretty much what built America, the productivity. Now, that's not happening. What we are seeing is stagnant growth or no growth, and we are seeing the nominal GDP is rising only because of inflation. And again, the Fed balance sheet, which should fund all of this, that's not rising. So that's not good for stocks. So somewhere along this, like one of these metrics has to change in order for the stock market to resume like an Argentina-like uptrend, right? Where you can have inflation, but stocks do well. And I don't see that happening until the Fed changes course.
Yeah, well, it's interesting. I was also listening another podcast called Macro Voices. So the argument is exactly that. They were saying, well, interest rates are rising right now. So, they're 6, 7. At some point, I think Jamie Dimon's come out and said 7%. And why that number? I think a lot of people are looking at that and saying, at 7, 8%, basically, unless the Fed steps in, the US is bankrupt. And we all know the US isn't going to bankrupt. Obviously, they're not going to default. They're just going to print. And at some point, that printing is going to become inevitable. So I think there could be a bit of that, right? Like you said, people are saying, eventually it's going to happen. So why not buy stocks now, right? I think that there could even be a bit of a dynamic playing out.
Right. You listen to FinTwit influencers like Raoul Pal, all they say is more cowbell, meaning more QE. And if that doesn't happen in September, they're like, no, it'll happen in December. If it doesn't happen in December, then it's 2024 thing. But they are pretty consistent in their message that the Fed is going to start printing. And unless the Fed does something to discourage such expectations, everyone's going to, so you've seen something happen for 14 years, right? If you're in your 30s, you came into finance at a time when the Fed was printing money. You spent your whole career in finance during a time when the Fed was printing money. Even go back, like you started after the dot-com bust, what did you see? The Fed was printing money. So all you have seen is a Fed that has been printing money pretty consistently for the last close to 2 decades. And now Jerome Powell comes and says, no, we have changed our policy. We are going to let interest rates rise to its natural level and we are not going to print. And then you see the Treasury just going on a binge, issuing debt like, it doesn't matter. And then you see the Fed balance sheet, and the Fed is now technically bankrupt, right? So what they do is they create an asset which hides their loss. So they convert their loss into an asset on the balance sheet, so they balance the books. And that's what they've been doing. But the Fed is technically bankrupt because a loss is not an asset, right? So any other institution which tries to do what the Fed does, they would be declared bankrupt. But the Fed cannot declare bankruptcy, so they create asset which, hides the loss. And so people look at the Fed balance sheet and they think the Fed is not going to want to have this loss on its balance sheet. So they're going to print, they're going to take the value of their own assets up so that they can bail themselves out. So you have this dynamic in play as well. And I really don't know how this ends, but I mean, the Fed is basically trapped, right? So if the Fed prints money to finance the deficit or dig itself out of its own technical bankruptcy, inflation is going to go straight up, especially with oil where it is and the conflict in the Middle East. Inflation is going to go straight up. And if the Fed doesn't print, we get an environment with no growth. We get pretty much what we are seeing where everyone is frustrated, right? Because stocks can't go up or down. Real estate, nothing is happening because you cannot finance property at these rates. So it's just impossible. And you're just dragging out the mystery because every month inflation stays this high, middle and lower income Americans suffer. And they've already been suffering since 2021. And the longer you drag this out, there'll be a political solution. You're seeing this with the Hollywood strikes, the auto workers strikes. You saw this last year with the longshoremen at the ports. They were striking. Pretty soon you're going to have strikes all over the place because inflation is something that makes people very miserable at the ground level, right? It's something that affects you every day in every purchase you make. I mean, you and I, we may work from our homes, not go out much, and we don't see this, but someone was actually out every single day spending as part of the process of making money. Like, let's say you're a handyman or a plumber or a taxi driver or pretty much anyone who's in any job that requires you step outside the house, you're confronting inflation every single day. And the longer it drags out, the more you're going to want a political solution. That's why the Fed is afraid of the 70s. That's why Powell keeps talking about not wanting to be an Arthur Burns, right? And that's precisely this reason, because once inflation gets out of control like that, you get a political solution. Right. And the political solution is not good for the rich people who actually control the Fed. The Fed is a private institution. It's controlled by private people. And this may sound like a conspiracy theory, but if you read the creature from Jekyll Island, you'll know exactly what I'm talking about. So again, so they don't want that solution. They don't want that political solution. So the Fed is trapped. And that is I can't see a way out. Right?
Yeah, it's very interesting. I've seen you throw around the term stagflation before. Is that kind of what you imagine, that kind of persistently high inflation with not really any growth? So then obviously the stock market, you looking at something like the 70s, 80s, obviously stocks didn't perform great at that time. Obviously what did do a little better was something like gold, oil. Is that where your interest is then? Something like gold and oil?
Sure. I mean, so if everyone knows the 70s, everyone knows gold went from a controlled price of $35, $42 all the way to $800. Everyone knows the Hunt brothers. They know that lumber shot up, oil shot up, all these stories. But again, that was the 70s, and 70s was a time when technology wasn't where it is today, right? Sure, you had radio, you had microwaves, you had televisions, but it wasn't something that permeated our everyday lives. I mean, semiconductors wasn't a term back then. So a return to the 70s is not exactly something that is going to happen now.
Right.
It's going to be a very different cycle. And again, in 70s, China was under pretty much an iron curtain of its own, right? You had the whole cultural revolution and stuff going on. China wasn't part of the world economy. India wasn't part of the world economy. And all of that has changed. So I think the dynamics this time will be very different, but sure, the same stagflation theme is going to play out. Unless, of course, we get a massive deflationary shock, like for instance, the Fed hikes by 50 basis points and increases QT to from 95 billion a month to 170 billion a month or something. And then they just bring everything crashing down. I think the longer the status quo goes on, the longer I think we'll get to a stagflationary period, which will last for a pretty long time.
Mm-hmm. Right. Yeah, absolutely. Yeah. At this point, I think it's almost more about the QT. I mean, the rates, they can stay up, I think, but it really comes down to that QT and the size of the balance sheet, I think. But I will see, because like I said, I think that eventually, well, I know that it's what everyone expects, but the US can't go bankrupt. So I think eventually something's going to have to push one way or the other, right?
Yeah, I mean, there's the other aspect to it. Like, I mean, sure, like now we accept the dollar as a reserve currency, but the more the treasury weaponizes the dollar, I mean, it started with kicking Iran out of SWIFT, which didn't matter in the grand scheme of things. Then it started with kicking Russia out of SWIFT, which again had some kind of pushback, but not much. But now you have the situation where the US has just weaponized the banking system against everybody, right?
Right.
So the longer this goes on, it's hard to tell. And you have US presidential candidates openly talking about wanting to exclude China from accessing the US market. So you see a situation, and China is the biggest holder of treasuries. You see a situation like this, it's hard to believe that the US currency can stay the reserve currency for much longer. And if that happens, then definitely the Fed will lose control. So you had this period in the 70s, the late 70s, when inflation was too high, and Jimmy Carter was the president, and they were issuing US government bonds in Swiss franc and Deutsche Marks, because external creditors did not want US dollars, because they're like, yeah, they just want to print the dollars anyway. So you could very well get to a situation like that. I mean, it's not that it just happens to Argentina or other basket case countries, right? You have debt to GDP at this high level. It could very well happen to the US. And it's something similar to what we have seen in Japan this year. For such a long time, the Japanese debt to GDP did not matter. For such a long time, the Bank of Japan's yield curve control did not matter. The Bank of Japan is the single biggest buyer of Japanese stock ETFs for the last 5-10 years. And none of that stuff mattered. And then all of a sudden it mattered, right? So history is pretty much that. And it was Lenin who said this, right? There are decades when nothing's happened, and there are weeks when decades happen. So I think we're kind of getting to that situation even with the US, right? I mean, this is the time that you really have to be careful with your exposure to the dollar and US assets, because things can just change in a heartbeat.
What
Like
what happened in Japan from it doesn't matter to it does?
I think it started with the change in governor, so there was some policy uncertainty there. And then when the US was hiking, Europe was hiking, Australia was hiking, Japanese were like, no, we're just going to do yield curve control. We're just going to keep continuing to do whatever we've been doing for so long. And at some point, I think investors had just had enough of it.
Right.
Now, I don't like the thing with central bank policies is you have one reaction which is immediate, and then one reaction which is, little longer down the road. And when the Bank of Japan said, we are not going to hike rates as fast as the Fed, it looked like a, prudent decision, because the Fed was just trying to break things. And Japan is a very tranquil society where they don't want to break things, right? So that's the whole difference between the American way and the Japanese way. So it seemed like a good idea. But then a year down the line, it looks like markets have had enough. And they are punishing the yen, they are punishing the Japanese bond market, and stocks are going up. So here's the other thing, like everyone talks about Japanese equities being in a bull market, but if you look at the two Japanese ETFs listed in the US, so I'm just going to go pull that up right now because I think it's relevant. So you have the DXJ, which is the ETF which has hedged for the currency, and that's up like 38% this year. And then you have the other ETF, which is EWJ, which is, just give me a sec. Just give me a second. So you have the other Japanese ETF, which is EWJ, and that's up like 9.5% this year. And the reason for this difference in performance is Japanese stocks actually haven't done well. It is just that when you look at the Nikkei in JPI terms, or if you look at certain stocks in JPY USD terms, it's like everyone's crowding into it, and it looks like Japanese stocks have done well, but they haven't. Because so the other dynamic with stocks in foreign currencies is that sometimes the currency depreciates more than the less than inflation that's going on in the economy. So for instance, you have a high rate of inflation, but the FX value does not reflect it. And then you have the other flip side of it too, right? So sometimes the currency just overshoots on the way up and down. And with Japanese stocks, what's happened is for a very long time, I mean, going back to at least 2016, 2017, asset managers were talking about how Japanese stocks are cheap, how all these conglomerates, I mean, they were all priced at less than 10 times earnings. So it wasn't hard to find a big bank with a 2-3x earnings multiple. And they pretty much stayed at that level for years and years and years, and nothing happened. And then the perception about Japan changed, and suddenly these stocks just flew, like literally flew, and the currency tanked, and then Japan became the market that everyone talks about. So I think Japanese situation is unique because it's just something that's very difficult to trade, and that's something that's very difficult to understand also if you're not familiar with that market.
Mm-hmm. Right. Yeah. Well, I don't know. Is Japan unique? Or a lot of people point to Japan as like, well, it's simply ahead of the curve, right? And that's kind of what I was talking about before. That the idea that Japan's currency has done very poorly, but like the stock market, if you're a Japanese investor and you don't really have a lot of options, is the stock market that bad of an option to kind of protect yourself in that way?
Well, Japan. Sorry to say Japan is unique again, but Japan is unique in this aspect in that they have pretty open they don't have capital control. So capital is pretty free to move. And what's happened is that over the decades, Japanese capital has gone literally everywhere.
Right. Yeah.
Right. I mean, it's financed the whole world. So I think the Japanese do have options outside the stock market. I mean, it's different now. Like if you take a country like Argentina, it's very difficult to get your money out because you have capital controls, but Japan doesn't. So whatever happens to the yen, whatever happens to the domestic market, the investors in Japan can decide where they want to keep their capital. And right now, I think because the currency has depreciated so much, probably they are bringing their capital back because they see more opportunities in Japan. I think that's what's happening.
Sure. Yeah, that's very interesting. And like you say, I think there was that kind of tipping point where the rest of the world was doing something different. So now Japan had to change. We could be getting somewhere there right now, right? Because, first of all, obviously people holding treasuries for a long time. They said China, Japan, all these countries now divesting treasuries. That's actually one of the, I don't know if I would call it a conspiracy, but one of the reasons, some people are saying, well, that's why the Fed has actually raised rates, right? Kind of moving all those treasuries from foreign countries. And who's buying up treasuries? Suddenly, retail, right? US retail and US institutions are really soaking up those treasuries now. But, I think it's very interesting that this comes at a time where, a few months ago, we had the BRICS obviously come out and, it's been in the works for a while, but kind of inching closer towards getting that BRICS backed currency, which would probably also mean government denominate, a debt denominated in gold, probably. So, do you think that could be a kind of a catalyst that kind of pushes things for the dollar?
And so let me put it this way. I've been a gold bug since 2014, and I've read all the books, like the Austrian economists, the gold bugs, like you name it. I've listened to all their arguments, and every once in a while they come up with something. Like in 2012, 14, it was China is going to back the yuan with gold. Russia is going to back yuan with gold. And now it's like there's going to be a BRICS currency that's going to compete with the dollar. And really, you have to ask yourself, are any of these countries willing to give up their independent currency? Of course not. In even for the euro, it was so difficult. But for the euro, at least there was the Maastricht Treaty, and when they reunified East and West Germany, that was kind of when it was agreed that they would go with the common currency, and it makes sense because it's one single geographic region. Whereas BRICS, it's all over the place, right? I mean, you have South Africa, which is in a completely different continent. You have India and China, which don't see eye to eye, at least in public, on most policy issues. And then you have Russia, which is in a league of its own. And then like Brazil, which is again in a different continent. It's hard to see how they would coordinate and launch a currency. I mean, if a bunch of 20 African nations got together and created their own common currency, sure, I would understand it. It makes sense, like how the euro was created. If some Central Asian countries, the stands, if they got together and created a currency, I would understand that. And I would even understand if Argentina, like Javier is now saying that, they'll just get rid of the peso and adopt the dollar as their currency. So something like that happening, I would still understand that. But for these disparate set of nations to get together and have a central bank which dictates the fate for all of them, I don't see that happening. And you also have to look at the other thing that's happening with the BRICS is that UAE and Ethiopia and some other countries are planning to join the BRICS. They are asking to join the BRICS as if, it's going to be an alliance of some sort. And when you get to that stage, I don't think you're going to want a central bank as well. Right? I think it's more going to be a power alliance than a monetary alliance.
Yeah, it's interesting. I don't know how it would work. I was talking to Mike Fay also on the podcast, and he proposed the idea that, like you say, no one wants to give up their sovereign currency. I mean, I don't know how it would work, but it would be, I guess, technically possible for China to say, have their own kind of yuan, even like, the CBDC just for the people in China, and then kind of as an international vehicle have that gold-backed currency, right? Well, just essentially say trading gold internationally, I guess, which I could say. I think it's not unreasonable.
Yeah. And I traveled a bit through Asia, and what I found is that over the years, the Chinese currency is getting acceptance at the same level as the US dollar and the euro. Like you go to any of these foreign exchange places, and they accept Chinese currency, and it's not at a big discount or anything. It's like almost equal to them accepting euros and dollars. So I think definitely China is gaining that acceptance. And if at all, I don't believe it's going to happen, but if at all there is a BRICS currency, I think it would be the yuan dominated. It will not be dominated by rubles or reals or rupees or any of the other currencies.
Oh, yeah, definitely, yeah. But as a self-described, gold bag and Austrian economist, would you like to live in a world where we'll have a gold standard? Is that what you'd like to see?
No, not really. I would rather see a Bitcoin standard, because like gold has its charm, and the issue again comes to custody, right? So you have a gold standard, you are dependent on the banks and the vaulting facilities to stay honest and stay true. And would you rather trust the custodians and the accountants and the audits, or would you just trust code? Right? 20 years back, we didn't have the option to just trust code, but now we do. And as long as there are honest Bitcoin nodes out there, there is no way that Bitcoin can be counterfeited. Whereas there are a lot of theories. If you go read Gata, they talk about how all the GLD ETF gold is hypothecated and rehypothecated. And if you actually try to redeem it, it's not going to be there. So you have all those issues with the gold standard that you just don't have with the Bitcoin standard.
Well, arguably, I think Bitcoin, at the end of the day, loaning money is something that humans do. Even if you had a Bitcoin standard, there could be you could still have a bubble where, people are loaning Bitcoin and then they can't really pay it back, especially if you have smart contracts in there and stuff. That could happen as well, I think, to an extent.
Yeah. So if you look at US before the establishment of the Federal Reserve, you had crisis, And what would happen is people would take their losses and the economy would just move on, right? It wouldn't become systemic. So in 1907, when a bank failed, the Knickerbocker Trust, which started the supposed panic of 1907, what group of bankers got together and decided, okay, this is the solution, we'll work it out. Let's not, it was a panic. It wasn't a depression. You got your depression after the Fed came to being. So what I'm trying to say is that as long as you have free banking, which is what you would have under a Bitcoin standard, you're not going to have these huge, you're not going to have a systemically important financial institution. You're not going to have one bank that's getting bailed out in order to take over another troubled bank. And you're not going to have taxpayers footing the bill. If you make a mistake, you pay for it, which is pretty much how capitalism should work, right?
Right. Yeah, I think that's what a lot of people miss. That's kind of the point the Austrians harp on, which is, I think, saving companies, you could say, okay, it's not all bad, we're just trying to prop up some companies, some banks. But I think the big problem comes with the flip side of it, which is what you're not allowing is that natural process of liquidation and basically freeing up that capital for what should be, other endeavors, right? That in theory should be more profitable.
Right. I mean, if the way you had GM, Ford and all these auto companies going for a bailout to the government in 2008, if if they were go 100 years back when Henry Ford introduced the automobile, these were the big horse carriage makers and the bullwhip makers. They would have gotten a government bailed out and they would have been told to just produce and produce, even though there's no market for their product, right? And that's what happens with the bailout. You're just incentivizing zombie companies to stay alive when they really shouldn't be allowed to stay alive.
Right. And that actually, I was writing about this the other day, and I kind of pointed out that, maybe that actually kind of justifies a little bit the kind of the separation we've seen recently with the Russell and maybe some of those mega caps. Because, say what you want about the mega caps, but at least, they're definitely profitable, right? And then you have a lot of those companies in the Russell, those smaller caps, that side of the economy, which obviously with the higher rates is going to be suffering a lot more, right? I think that could explain a little bit maybe that difference. But that's
yeah, sure. And the Russell, it's and again with the market cap weight indices, what's happening is success begets success. Meaning you have these index funds, and everyone says, okay, indexing is better than stock picking, so you have people allocating more to index funds. And what do the index funds do? They buy the biggest companies in the index, so they get bigger. And you just have this whole virtuous cycle which is benefiting those companies. And the problem comes when you have companies in the Russell, again, like I talked about last year, where you had value stocks go up from a 4 PE to a 2 PE, even though there was nothing wrong with the company, even though the company is growing. And you get into this situation because at some point, the big companies just become the market and everyone forgets the rest. And this is passive investing coming full circle, right? Now everyone is passive. No one wants to do active anymore. And then at some point, this will turn. And then you'll have the cycle going in reverse. You'll have people, would you rather buy the entire, like Warren Buffett talks about, if you buy a stock, would you want to own the whole company, right? So would you rather want to buy Apple, or would you rather want to buy the entire United Kingdom stock market? It's the same. Market cap wise, it's the same. Would you rather want to buy Apple and say NVIDIA, or would you want to buy the whole Indian stock market? And they are at the same level. It's like the discrepancy is so, it's so blatantly obvious now that at some point there'll be a solution. It's like, it's like with the Japan example, everyone thought, oh, Japan's unique. And then it turns out, this year, it turns out it's not so unique after all. And I think with the mega caps, you're going to have something very similar happen. And we have seen this before. We have seen this with the Nifty 50 craze. There was this quote that went around wherein, they said, you can't get fired for buying IBM. That was a staple quote for an asset manager. Just buy IBM because, it's the big stock. And, you have these finance books which are more like journals where they just go back and talk about how families did during those times, right? And I read the story about a family where the father says, never sell your IBM share. And this sounds weird to us because IBM is just another company and it's not even dominant anymore. But in the 60s and 70s, everyone thought IBM it's like Microsoft in 2000s. And you just go back and see how quickly sentiment can shift. And for all you know, I mean, like in 2017, it was the FANGs. Now we don't hear about the FANGs. You hear about the Magnificent Seven. You have stocks that are like, no one cares about Netflix anymore, right? It's done.
Right.
So it's out, and NVIDIA is the new poster child. So these shifts happen, and once they do, no one's going to talk about them. So you're now going to hear about it, and then it's like, you move on to the next thing.
Yeah, absolutely. I think it's something humans suffer from. Obviously, it's recency bias, right? It's hard to think in those long-term terms. And if you think about all the current FANGs, really, I mean, look at them 10, 15, 20 years ago, they weren't even around. So just the way technology has reshaped the whole world and the market in the last 10 years, and who's to say they're not going to be reshaped in the next 10 or 15? The only argument I would say is that maybe, like you say, the technology now is, and the situation is that like they are literally too big to fail. I don't know. I still hold a few Google shares, and I definitely don't see Google going anywhere. But, I may be wrong.
Yeah, I mean, it's like Microsoft, right? Microsoft became a stable dividend-paying stock. Went from being a growth stock to a stable dividend-paying stock. And Microsoft isn't going anywhere because they have built something that the entire world needs. And it's the same thing with IBM. Like, you go to a big bank, chances are their backend runs on an IBM mainframe. Now, maybe the new fintech startups don't need an IBM mainframe, but the big banks do. You go to any legacy insurance company, like pretty much everyone uses IBM. And the reason is because they installed it back in the 60s and 70s, and rather than change, they're just going to continue with the status quo. And I'm not going to give up my iOS and my Windows. You're not going to give up your, dominant operating system. It's just 10 years from now, chances are those OSs actually just stay the same with upgrades maybe, but those companies are going to be around. Unless something like, like BlackBerry and Apple, or something drastic happens, in
Right.
this case, you get a yeah.
Yeah, it'd be interesting to see. Anyway, just to go back really quickly on Bitcoin and crypto before we wrap up, because, obviously big bull on Bitcoin, but the rest of crypto lately has been doing pretty badly. Even Ethereum, I think, a lot of people who look at the charts and got that kind of a breakdown in the Ethereum Bitcoin chart. I actually saw an article recently that was talking about the idea of Bitcoin getting Ethereum style smart contracts in it. What is your own view on Bitcoin versus basically the rest of the world? I mean, is there any hope for the altcoins here?
Well, so Bitcoin is dominant, and there's a reason for it, right? It's been around the longest. And the other reason Bitcoin has done so well is because whenever there's an altcoin that comes up with a capability Bitcoin doesn't have, Bitcoin developers figure out a way to bring that capability. Or if that capability is unimportant, then that coin just dies. So let me preface my argument with, I am a Bitcoin maxi, but I think there are use cases for crypto that go beyond the money. And the projects that are working on those use cases, they have merit. And so with that said, so the reason Ethereum has suffered is because the Ethereum Foundation has sold some Ethereum recently. So there's that negative press. And as for the altcoins, again, so we are still in a crypto bear market. It's been, the altcoins peaked around April, May 2021. So it's like a brutal 2.5 year bear market. But that's just it with early stage tech, right? Early stage tech only does well when the money printer is going well. Like, you need to have people with the capability to take risk, to fund risk ventures. And right now we are not seeing that. So how this plays out, how this ends, I think it again all goes back to the Fed. You need to have a cycle of risk taking come in for people to start valuing startups the way they did in the past. Like, the way a startup was valued in 1998, 99 is not the same it was valued post 2000. And it's pretty similar to what we are seeing in the altcoins, the crypto space now. As for Bitcoin itself, I think, so there are two things at play here. One of which I don't understand is Bitcoin had this huge run from like $19,500 odd in March when the Silicon Valley Bank collapse happened, all the way to like 32K. And then it's like just hovering around. But all these moves, if you actually pull up the chart, it's happening. It's like you have a huge move in a couple of days and then it just sits there doing nothing. And then you have another huge move and then it just, so that's not the way anything normally trades, right? Any asset, no asset actually trades that way. And the reason for this is the collapsing liquidity.
Right. Yeah.
So if you look at the USD or BTC pair on Binance or pretty much any exchange, you would find that volume has absolutely dried up.
Mm-hmm.
And why has volume dried up? There isn't really an answer for that. Could just be typical bear market behavior. But that's one part of it. The other part of it is you have MicroStrategy and you have all these other players who are accumulating Bitcoin without regard to the price. Now, in a way, this poses a risk too, because everyone who is accumulating Bitcoin is now sitting at a loss. So I think MicroStrategy's price of average acquisition price is around 29.5K or something. And Bitcoin's like obviously below that. And they've been doing this for more than 3 years and they are still not profitable in their strategy. So at some point, if they change course, that's going to be a big hit to the Bitcoin price because you're going to have that huge volume enter the market. Now, MicroStrategy, Michael Saylor is pretty clear that he's not going to do that. But what about all the people who imitated Michael Saylor in the 2020 to 2021, 22 times? Are they going to just stick with the strategy in the downtime? Because typically, bad markets test people's patience. Mm-hmm. So although Bitcoin has done well, the lack of volume and the fact that you have this dynamic with the MicroStrategy influenced hodler group, I don't know what's going to happen. I mean, I wouldn't at all be surprised if we see a move back to 20K or lower, and it happens just the way it has gone up, right? And like few swift down days, it just goes there. And that totally makes sense with the fact that there's no volume. And so this ETF, so let's get to that. So that's, I think, the main reason there's been so much speculation. Every time this ETF news has come out, right, Bitcoin has gone up and then it has reversed. Like the ETF news, so during the bull market, there was a time when Elon Musk just tweeted Dogecoin and it shot up, when he just said Bitcoin is on the balance sheet and it shot up. And now we have this dynamic where there is something that's actually happening that's beneficial for Bitcoin adoption in terms of getting more players to put more money into it. And what's happening is the price is not responding. So I think that's pretty consistent with my view that it's in a bad market, and the declining volume plus all these factors make me, so if I were trading it right now, I would not be trading it. If I were recommending it for a long-term allocation, I think that's something that you always, will have, right? Like how you have your gold. So when you view it as a investment that's for a different purpose than just getting you immediate gains, I think that's the only time you would be in Bitcoin. And as for the alts, again, like the time to buy. So I worked for a company where we looked at gold mining stocks, the exploration stocks, the ones which are just not drilling holes in the ground looking for gold. And the time you buy those companies is when sentiment has absolutely washed out. There is no volume because no one wants to trade these anymore. And every single piece of good news that they put out is met with more selling. And if you look at the altcoins right now, I think they are at that stage. So I'm pretty sure some of them will go to zero and some of them will go 100x in the next cycle. So if you know what to pick, then of course you're going to do very well buying at this time rather than buying at other points in the cycle where, you're paying a higher premium. So yeah, that's how I would approach Bitcoin and crypto right now.
Interesting. That makes a lot of sense. I'm curious, you talk about the gold miners trying to buy the speculative plays when the sentiment is really bad. I mean, I don't know. I mean, it has rebounded, but sentiment did get quite bad on gold, a few days ago or a few weeks ago. Is now a good time to buy those speculative gold names? And if so, any names out there you'd like to share?
No, I'm definitely not sharing individual names, mainly because most of these stocks that I'm looking at, they don't trade. And if they trade, again, they're going to get pretty popular. And I haven't done full
They
research.
don't trade. How you?
So like you have these companies. So sure. So most of these gold exploration stocks are under 100 million Canadian dollars of market cap. And by they don't trade, I mean, you have these days where you'll have 4,000, 5,000 shares change hands. And these are stocks that trade at under $1. So that's pretty much non-existent volume, right? So I don't want to put out something and then have it go up and be like, oh, this guy is a penny stock promoter, like that's something that I want to avoid. So yeah, I mean, broadly, if you're looking at the gold exploration plays, I would stick with the ones that are listed in Canada and have their assets mainly in North America. Because if you are going further out, you're better off, engaging someone for their expertise and then going further out than just, like buying the stock in, which is doing something in Ecuador or Peru or something. Like, you better be very careful when you're doing something like that. But if you're just looking to allocate to the space, then, I mean, you can just stick to the GDXJ and the SILJ in those ETFs, or you can just go with the companies that are between 500 million to $1 billion in market cap, which is a pretty safe space to be, because then you can use stop losses and you don't have to worry about lack of liquidity. So that's what I would tell someone, like, unless I'm particularly recommending something after having done the work to my clients, then I would say that, broadly, this is a safer way to play.
Absolutely. And just say, I'm flattered that you think the podcast could actually significantly impact the share price. Hopefully one day. I don't think it's quite there yet. Anyway, Kashyap, thank you so much for coming on. Where can we find people on the internet to find your work?
Yeah, so on Twitter, it's at Kashyap286, and then there's my website, it's kashyapsriram.com. I also run a Telegram group which is free to join, where I just post out random thoughts and trade ideas, so in real time. So those are 3 good venues.
I didn't know that. I'll definitely be joining that Telegram group.
Yeah, looking forward to seeing you there.
Awesome. Well, thanks for coming on, and look forward to doing this again sometime.
Yeah, thanks, James. An absolute pleasure for me.
Bye-bye.
Right. Yeah.
Thank you once again for listening to The Pragmatic Investor. If you're still around, I take it you enjoyed the content, so please go ahead and like and subscribe. And remember that you can also follow me on Substack and on Twitter. The links will be on the description. I do a free weekly newsletter on Substack covering all the macro developments of the week and actionable investment ideas. Thanks for listening and have a great day.